Most investors spend years chasing hot stocks, timing the market, and still end up underperforming. But what if a simple portfolio one, almost anyone can build, could quietly beat the majority of investors over the long run? In this video, we'll break down the straightforward strategy used by some of the world's smartest money managers, why simplicity often wins, and how you can start building wealth without constantly watching the market. Today we will talk about the simple portfolio that beats most investors. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why simple investing is a powerful idea in modern markets. The concept of a simple portfolio that beats most investors is based on one uncomfortable truth. Investing complexity rarely translates into better returns. In fact, complexity often reduces performance. A simple portfolio typically means holding broad, diversified funds, such as total market index funds, rather than attempting to pick individual winners or time market movements. The reason this works is because modern financial markets are extremely competitive, with millions of participants, including hedge funds, algorithmic traders, and institutional investors with vast resources. In such an environment, consistently finding mispriced assets is extremely difficult. A simple portfolio removes the need for prediction and instead relies on capturing the overall growth of the global economy. Over long periods, global equity markets have historically returned around 6% to 10% annually, depending on inflation and region, and a simple portfolio ensures the investor earns this market return without unnecessary friction. 2. The evidence. Why most investors underperform. One of the strongest arguments for simplicity comes from long-term data. Studies from institutions like S&P Dow Jones indices repeatedly show that over 10 to 15-year periods, more than 80% to 90% of actively managed funds fail to outperform their benchmark indices, such as the S&P 500. This means that even professional fund managers with advanced tools, research teams, and years of experience generally do worse than passive index tracking strategies. The reasons are structural. First, active funds charge higher fees, often between 0.5% and 2% annually, while index funds can cost as little as 0.03% to 0.10%. Second, frequent trading leads to higher taxes and transaction costs. Third, active managers are still human and subject to bias, such as overconfidence, herd behavior, and fear during downturns. When these disadvantages accumulate over time, they create a significant performance gap that simple portfolios naturally avoid. 3. What exactly a simple portfolio looks like in practice. A simple portfolio is not random or unplanned. It follows a clear structure. A common version is known as the 3-fund portfolio, which includes 1. A domestic total stock market index fund, 2. An international stock market index fund, and 3. A bond index fund. For example, an investor might allocate 50% to a U.S. total market fund, 30% to an international developed/emerging markets fund, and 20% to a bond fund. Another simplified version is a 2-fund portfolio, which uses only global equities and bonds. Even more simplified approaches include target date funds, which automatically adjust allocation over time based on age and retirement horizon. The important idea is not the exact percentages, but the principle: broad exposure, low cost, and minimal decision-making. This structure ensures that the investor is not betting on individual companies or sectors, but instead owning a slice of the entire global economy. 4. Index funds, the engine behind simplicity. Index funds and ETFs are the foundation of simple investing. A fund tracking the S&P 500, for example, gives exposure to 500 of the largest U.S. companies, including Apple, Microsoft, Amazon, and hundreds of others, instead of analyzing financial statements or predicting quarterly earnings. The investor simply owns the market. This eliminates stock picking risk, which is the risk of choosing underperforming companies. Index funds also provide automatic rebalancing, meaning underperforming companies naturally decrease in weight while growing companies increase in weight. This self-correcting mechanism is one of the reasons index investing is so powerful. Additionally, ETFs and index funds are highly liquid, transparent, and tax-efficient compared to actively managed funds. Over a 20 to 30-year horizon, even a 1% to 2% cost advantage compounds into tens or hundreds of thousands of dollars in additional wealth.